4.
Order. Welcome to the Treasury Select Committee on 6th of March 2025. Today we're speaking to the Monetary Policy Committee, or members of the Monetary Policy Committee, about the Bank's Monetary Policy Report of February. And I'm really delighted to welcome Andrew Bailey, of course, who is the Governor of the Bank of England. And he's joined by Dr. Hugh Hill, who's the Chief Economist at the Bank of England. And they're joined by two members of the Monetary Policy Committee, two external members, Professor Alan Taylor, who was in front of us the last time we discussed this, and Greene from the Monetary Policy Committee. So a very warm welcome to you all. Obviously, there was quite a unanimity of opinion this time in the votes, but perhaps I could just go through each of you in turn, just so you can explain your rationale for why you voted the way you did, and what considerations you had in your mind in taking that position. So I think I'll go from left to right, if that's okay, Mr. Bailey, to Professor Taylor first.
Okay, thank you, Madam Chair. So I'll maybe go through at three levels. First level would be sort of global and historical, and how I saw the developments in that kind of perspective. Then I'll talk about the trajectory of the economy coming through and out of 2024. And then lastly, I'll talk about four key data points that went into my thinking at the time of the decision. So the top level is the current local and global economic environment. And look, I would just say we're living in an age of uncertainty, and it's crucial to understand that. There's a longer term part of that. Look at the recent past, going back 17 years, we've had 6 massive shocks: a global financial crisis, the Eurozone crisis, Brexit, the COVID pandemic, the Russia-Ukraine war and associated energy shocks, and this, whatever we'll end up calling this that we're living through. And those kinds of big shocks leave big scars. They're very unusual in a longer run historical context, occurring so often in such a short span of time. And the effects in economic theory, but also in empirical research, is generally a direction on the behavior of households and firms in the direction of wait and see, of pausing big decisions, pausing investments. And I think that was the kind of overall backdrop, even in 2024, when I joined the committee and informed some of the answers I gave in November. So narrow focus now on just 2024, consistent with that view. There was decent growth early on, like in the first quarter, and I think it was expectation in the bank and also in private sector forecasts that would translate into some optimism. It would translate into growth. It would maybe unleash some animal spirits. There'd be some positive feedback or a virtuous circle. That didn't materialize. Consumers kept saving, and saving actually rose. Businesses continued to postpone investment. I heard that in Edinburgh in October. I was in Leeds in January. I was just in Bristol last week. And it seems like that's a recurring theme in the second half of last year and into this year. And that was just an element of pessimism, sort of consistent with the precautionary kind of backdrop. And the way that manifests, I think, is when you have uncertainty, it will feed through first into demand. People will defer consumption, defer investment. Of course, if it goes on for a long, long time, a decade or more, that will eventually feed into supply. I mean, if you're not making the investments, you're not improving the capital stock, eventually you're going to pull down the rate of economic growth and productivity growth. So we saw in 2024 sort of more of that kind of demand shocks dominating supply shocks, in my view. We had disinflation at the same time as weakening activity, and that correlation is kind of first-order evidence that the demand shocks are dominating. We saw that in sentiment. We saw that in the fall of vacancies relative to unemployment, a modest rise in unemployment, rises in desired hours, some attrition, I think, in terms of employers, but not yet major redundancies. The output gap closed, and we entered 2025 with slack appearing, I think, in both the labour market and in terms of the output gap. And my personal view, though, different from the Monetary Policy Report, would be that we probably have a bit more of an output gap than we have in the report. We had very big negative news between November and February. I would have put more of it into the output gap, but we put most of it into supply. So that's a point of difference. So overall, that said to me, that backdrop, we should still be normalizing policy gradually. But as I said in November, the risks to me were to the downside. Okay, has that changed? Well, coming into February, coming to what guided my vote, I'll lay out 4 features of the data, which I'm weighing up. 2 were sort of in an encouraging direction, 2 a bit more a cause for concern. So disinflation had continued, and in terms of services inflation and as well as the whole basket during 2024, as expected and kind of smoothly. We thought there would be bumps, there were, and there will be in 2025, and we'd already forecast that in November. We also got the agents' pay survey coming in at 3.7 for 2025. That's the expected wage growth this year, which is substantially lower than the figure around 6 that we had last year. So wage inflation is expected to trend down towards what is probably the ultimate sustainable long-run level around 3-ish. So those are the positive notes. The more cautionary notes were a bump in our inflation forecast, not due to supply and demand pressures fundamentally, but due to one-time tax and administered price increases, most importantly the off-gem price moving, contributing plus 0.4 to inflation. We also had a big increase in water prices because there's a front-loaded increase in the Ofwat tariff. There's bus fares and VAT and so forth. Now, normally you would look through those kinds of one-time shocks and you would say that's a shift in the price level and not an indication of fundamental inflationary pressure in terms of a trend. And of course, if it was one of those shocks, a 0.1 here or a 0.2 there, you'd be quite relaxed about looking through it. But when it's 5 or 6 of them, a 0.1, a 0.2, a 0.3, and they're adding up to 1, you feel a little bit more cautious about looking through all of them at the same time. You maybe have some concerns about, is that going to feed through into inflation expectations? Where will it take us next? So that was note of concern 1. Note of concern 2, private pay growth in the AWE from the ONS. That had been falling smoothly throughout 2024, but in the final months, it made an unusual U-turn. It looked odd to me. It didn't line up with our other indicators that we use in the bank, and it influenced my thinking. So new data points may come along. Possibly the past data will be revised, but until we get that, it's hard to get a clear signal on the direction of travel of wage growth. So summing up, those 4 pieces of evidence were in my scales. I saw both upside and downside risks, but I weighed them up kind of evenly and thought we can stay on this gradual path. I saw no strong reason to hold, no one else did, and I saw no strong reason to go for 50. So summing up, I did strongly argue for the use of the words gradual and careful in the statement, which is my way of saying, kind of along with the middle of the committee, the median voter, that I see the risks as being two-sided because of this uncertainty that has widened. Whereas the word or adjective cautious might be more associated with one-sided risk. So I thought it was important to put that in the statement as a form of communication. And of course, that uncertainty has only widened from November up until the February vote, and then from the February vote up until now. Even in the last 3 or 4 days, it's widened considerably. So therefore, I think we do need to be attentive to all signals going forward. And as far as I can see, every meeting coming up for the MPC will be a live meeting, because I think that's the nature of things when you're making policy in a time of extreme uncertainty.
It was really comprehensive and helpful. And when you made this very interesting speech in January, and we were interested to hear what you had said last time, and in that speech, though, you weighted the probabilities of the 3 cases at 40% for the dovish case, 40% for the central case, and 20% for the hawkish case. Would you like to confirm those numbers? And it would be helpful when others answer if they could give their weighting on those cases as well.
I think, we'll probably talk about this some more as we go on, but there are so many shocks happening right now that I don't think I would move my central distribution much from that. I would just say... It would
be odd if it moved massively from January.
My certainty about any of those numbers has gone down significantly.
Okay, thank you. Megan Greene, keen to hear from you.
Yeah, thank you. I guess my main message is that I think that the disinflationary trend that we have had is broadly on track, even though we have this near-term increase in inflation in our forecast. And also that you mentioned the 3 cases, I think we continue to be in a case 2 state of the world, which involves an output gap opening up to bear on inflation persistence and squeeze it out of the economy. And so those two things really motivated my vote to remove some restrictiveness at our last meeting. But to my mind, the risks have shifted a bit since we started this rate-cutting cycle in August. As you've noticed, GDP has roughly flatlined since March, and how that affects your policy views really depends on how much you ascribe that to supply versus demand. And I think there are reasons to think that actually it's probably both. As Alan mentioned in our forecast treatment, we've put a lot of that into supply. I'm actually worried it's even more in supply than what we have in our forecast. I think there is a narrative that makes sense that suggests that policy uncertainty domestically and globally, higher taxes, might have weighed on demand over the past couple of months. My problem with that narrative is that, as Alan mentioned, we've seen AWE, private sector regular wages, take up. They're volatile, but actually our own indicator-based measure for wages also has ticked up, and all other indicators are pretty high still. We've also seen some domestic cost pressures increase, particularly for food and core goods inflation, and that's what I would expect to see if there were a supply constraint in the economy as well. So I'm a bit concerned that there's a supply constraint now, and also that looking out through our forecast period, we expect supply to recover, and I think there's a risk that it won't. Productivity growth and potential growth, therefore, might not recover as we're expecting. So to my mind, I said that I think the balance of risks have shifted since we started this rate-cutting cycle. I think given the supply constraints, the risks have shifted away from a case one state of the world where external shocks kind of unwind on their own and inflation comes down, towards a case two or case three state of the world, where actually it will require monetary policy to continue to bear down on inflation persistence.
Just from the two of you, lots that we're going to be probing later, particularly about some of the global shocks. Governor Andrew Bailey.
Well, thanks, Chair. I mean, Alan and Megan have put it very well, actually. But I'll just pick out a few things. So my decision to vote for a cut was grounded in the underlying disinflation story still holding with, and this is why we use the word gradual. I mean, the gradual, in a sense, erosion of the persistent element of inflation from the shock sort of we had sort of 2-3 years ago now, a bit more than that, is continuing, and that's probably best illustrated by looking at core services inflation, which actually came down in the latest number. And I say that because that's one of the better measures of sort of what I call the sort of underlying balance of activity in the economy. So that's the grounding for the decision to vote for a cut. Now, as Alan said, we are, to state, I'm afraid, the sort of blindingly obvious, living in a world of even greater uncertainty than we were probably last time we were here. And I want to come on to that. I'm rather more in the case two with sort of balance on either side than probably Megan is, but that's reasonable people can take those views quite reasonably. And then there are four things I would pick out, and I will only talk about them very briefly because I'm guessing we'll come back to them. First of all, this question about activity and the fact that we've had very flat activity really since last spring. And the question that Megan's just talked about, which is it supply or is it demand? And I think two things there. One is, it's actually quite hard to tell at the moment, but I think it's some of both. My view is a bit more balanced in sense that probably a bit more it's a balance between supply and demand, but it's clearly we've clearly got to watch that story very carefully as it evolves. So the activity story is the first one, and the uncertainty, and and I'm sure we'll also come on. There's quite a lot of uncertainty about some of the numbers as well, frankly. Second thing is that, as we've highlighted,
any particular, obviously we've talked about the labour force.
Yes, I think the other thing I would add very briefly, because you may want to come back to it, is one of the things we saw last year. We've had an increase in the size in the population as estimated. Some of which has come through into the labour force, and some of which is yet to come through, but will do, in terms of how the ONS built it in. So when you look at last year, put simply, we've got a bigger population, but we've got the same output and activity. Now, the only way you can sort of square those two things sort of arithmetically is productivity was weaker. And in fact, last year we had negative productivity growth on the year. That's very unusual in a year when we didn't have a recession, actually. So now that would support a weaker supply side story, but it sort of leaves you wondering what's really going on here, actually. There is, happy if you want to come back to this one later, I'll just flag that there's also a question about public sector productivity and exactly what's going on there. Because the numbers are quite striking, but again, how much is it real, how much is it measurement, what's it times? Measuring output in the public sector is hard, statistically. So that's an activity story. As we highlighted, we do expect, and I'll begin to see, a pickup in inflation. Now, just to be clear, it's nothing like what we saw a few years ago. It's all of the reasons for the increase are due to a combination, really, of energy prices. Again, can come back to that if you like, particularly gas. Some stuff on food, where there's some particular shocks seem to be going on, and then administered prices, so water, bus fares, VAT on private schools, those sorts of things. Again, the reason I say that is they're not telling you much about the underlying sort of state of the economy. But the question we had to address was, well, is the old one, is this going to have second round effects or not? Now, my view is at the moment, I would say less likely, and that's a sort of contextual point, really, that set against a weakening pattern of the economy, probably less likely. However, since some of it is in energy and food, those are the two things that when you ask people what shapes their perceptions of inflation, those two things, because we all consume them most frequently, they do have quite a big impact. So we have to watch that. And secondly, of course, you've got the sort of the hangover effect from the last shock with people saying, inflation's going up again, is it? So we have to watch that carefully. The third one is, and obviously we may come back to this, is obviously how the national insurance change is going to feed through. And then the fourth one is the state of the world at large, where we may come back to that as well.
We're going to come into that.
You put all those four together, that's a lot of uncertainty. So I'm very much, as Alan said, two-sided risks here, and my sort of two-sided risks have increased, so that bears out Alan's point about uncertainty.
Thank you. Dr. Pill.
Thank you very much. So quite a lot has been said already.
We always tell you, so you don't have to repeat it all.
But I haven't been here for a while because of the election, so it's my first time with this group. So if it's okay, I would quite like to start with a slightly bigger picture view and a bit echo things you've heard from Meccan and the Governor. I do think it's important to recognise that the process of trend disinflation following the very large pandemic and invasion-induced inflationary shocks has continued over quite a long period now. A big part of the fall in headline inflation we've seen from its peak above 11% down to levels which are closer to, but unfortunately still not at, our 2% target, owes to the dissipation and in some cases the reversal of those external shocks that originally drove inflation up. But I also think it's crucial that we recognise that this process does have monetary policy at its centre. I think there's two aspects to that. We've got a monetary policy framework that's established price stability as its objective. It's expressed a clear quantitative expression of what that means in the form of the 2% inflation target, and it's given the MPC independence to pursue that target. And I think that's proved to be very important. I think it's also been important that the MPC itself has established in the course of 2022 a restrictive stance for monetary policy to bear down on inflationary pressures, as Megan described. And taken together, these two features have contained the second round effects that threatened and have helped maintain an anchoring of longer term inflation expectations at rates that are consistent with our 2% target. And that's helped prevent the more lasting and more costly deviation from price stability that had followed previous energy price shocks like we saw in the 1970s. That's a topic that we've discussed on previous occasions in this committee. Now, I think, of course, it's the case that disinflationary process is proved quite prolonged and it's proved occasionally bumpy, and we are again seeing some upward pressure on headline inflation, as others have mentioned. We hope in the short term coming from further volatility in energy prices given by the uncertain environment and external events, and I'm sure we'll discuss these later, so I won't dwell on them right now. Other than to note that they are a reminder that we do need to remain vigilant to new shocks and disturbances that might threaten our path back to the re-establishment of price stability. So then I'll just quickly turn to the recent decision. So from my perspective, it's that continued progress with disinflation towards the 2% inflation target that's created scope for the MPC to reduce the restrictiveness of monetary policy and thereby to cut bank rate a further 25 basis points at the February meeting. And as you've said, that's a decision which I supported and I voted for. But I think it's equally important to recognise that the success that we've achieved in this disinflation process thus far does not mean that it is complete. So I think there continue to be echo effects from the large pandemic and invasion-induced inflationary shocks, and they haven't yet totally disappeared. And that's reflected in the persistently elevated rate of underlying domestic inflationary pressures that we're seeing. That's illustrated in the continued strength of services price inflation and pay growth, among other indicators. And I think that's consistent with what Megan said about concerns about weakness on the supply side of economy, suggesting that there is less slack in the economy and more resource pressure in the economy than perhaps some indicators, including perhaps the base case in the monetary policy report, might suggest. So in my view, there is more work to do to squeeze those domestic underlying inflationary pressures out of the system. That entails maintaining some restrictiveness in the monetary policy stance, and that points against both larger and more rapid cuts in bank rate at this point. And that's the basis for why I favoured a cautious and gradual approach to the withdrawal of monetary policy restrictiveness. That's been the case really for the last year. I spoke of this in the summer of last year, and I've supported communication in that direction following the February MPC meeting. I think there's quite a lot of consistency and continuity in that approach. So looking forward, my assessment is that further progress with disinflation would permit further withdrawal of monetary policy restrictiveness and further reductions in bank rate over the rest of this year. But the magnitude and pace of bank rate cuts has to depend on how the risks around that disinflationary path evolve. So on the one side, and I agree with the point that there are two-sided risks, on the one side, weaker demand would ease resource pressures and permit a somewhat steeper path of bank rate reduction, but continued weakness in productivity growth or wider disruptions to the supply side of the economy that perpetuate and intensify this nominal persistence that we're seeing in price developments, cost developments, and wage developments. I think that would likely sustain this underlying domestic inflationary pressure in a manner that would require a slower removal of monetary policy restriction. And that's the framework within which I'm organising my thinking. Just touching on the cases, so I first talked about the cases back in July last year, so I haven't had the opportunity to talk about them here. It's interesting, when I first talked about them, I focused mainly on now what we call case 2 and case 3. I think that reflects where the bulk of my perspective
Central and
is.
hawkish.
I would say that I haven't personally changed my own kind of view of the probabilities, which have been tilted that way for the bulk of this period. And I sort of see the data that we've seen over the last 6 to 9 months, not so much as a surprise, but more a support of that view I've maintained.
That's very interesting. I mean, it's hard to summarise 4 of you, such eloquent economists, but we did note, and I think it reflected in what you say, that the word uncertain, the mentions of uncertain in the monetary policy report have interestingly risen from 30 in August, 43 in November, and 62 in February. And I think you're all nodding. Yeah, I think from what you said, that is what's wrapped around.
We hadn't counted them, but that seems fair enough.
Yeah, but wrapped around the decisions. And obviously you've been clear, Dr. Hill mentioned it, that the 2% target is still in place. So I'm going to come to Lola McAvoy on that issue. Ms. McAvoy.
Thank you, Dame Meg, and hello everyone. Nice to see you again, and welcome, Dr. Pill. Just to go back on the 2% point, so can you tell us a little bit more about your views on the 2% target? Are we still on track? And what's your broader view on having an arbitrary target and how it's improving the disinflation?
So in terms of the character of our target, I think there's two parts to that. First, why have a target and make it a very specific number? So I think there are lots of benefits in terms of transparency, supporting the clarity of our communication with having a specific index identified and a specific number that we associate with price stability. I think that has helped over the many years, including in my involvement with the MPC and in this committee with our communication. It helps to hold us accountable, I think. So I do think that's important. Of course, our ability to meet that target on a continuous basis is compromised by all these uncertainties and shocks that we face. So I think it needs to be interpreted both on the MPC side and on your side, and indeed more widely in an intelligent way, recognising the uncertainties we face, recognising the lags in our policy transmission process, all of which make kind of month-to-month, let alone day-to-day, stabilisation of inflation at 2% pretty much impossible. So that kind of medium-term, forward-looking orientation, I think, remains extremely important. I did recognise that you said it was a bit arbitrary, and I think you're right if you're pointing out there the number 2% or the specific choice of the CPI headline index rather than other, there is an element of arbitrariness in that, although I do think maintaining a consistent approach through time helps to bolster both the communication and credibility of those targets. So I would be, it's not my job as a member of the MPC, it's the job of the Treasury and the government to set the target, but nonetheless I think those are important features. And crucially, going back to what I said earlier, I think having this target has been an important element through this quite challenging period we've had over recent years in helping longer term inflation expectations in financial markets amongst households in firms remain well anchored. It has given a clear guidance of what we're trying to do. I think we have committed and delivered on moving in that direction, and we're making progress with that, as I've said. And I think that stabilization of longer-term expectations on the basis of the target is one of the key differences between what has happened through the course of this external shock episode relative to that which we've discussed on previous occasions in the 1970s and early 1980s, which, as I also said a moment ago, turned out to be much more prolonged in terms of its departure from price stability and much more costly to arrest. In terms of what progress we're making, I think, as you know, in the spring of last year, we did get mechanically back to 2%. I think at the time, many of us on the committee did say, don't be lulled into a false sense of security, because just as there were upward impulses to headline inflation coming from the very strong energy prices, the quite rapid fall of energy prices, albeit not back to where they started, but nonetheless a fall, did contribute negatively to the construction of the inflation measure we target. And that would drop out, and that's what we have actually seen over recent quarters and months. So that short-term volatility is beyond our control, and we need to look through it. Several of us have made this point.
Yeah, so,
I suppose the only other thing that I wanted to pick up on that, so you've said that it's helped mitigate this time with the external shock episode. Do you think having the 2% target as we navigate uncertain times will help with investor confidence?
Well, I very much think that. So I do think our framework is based on a view of the world, which fortunately for me is a view of the world I strongly share, which is monetary policy makes its best contribution by stabilizing prices, providing a credible forward-looking view that macroeconomic stability centered on achieving the inflation target will persist. And it's by taking out the sort of unnecessary uncertainties, that uncertainty about policy or uncertainty about what the path of inflation and therefore interest rates, both short-term interest rates and longer-term interest rates, would be, that we're creating an environment that all those long-term decisions, be they decisions by firms about investment or about individuals about buying houses or education, all these longer-term decisions force you to think about, well, how much is it going to cost me to borrow? What is the economic stability going to be like in 5, 10, 15 years' time? And I think we're providing the anchor that says, yes, it's difficult to take out all these things we're facing in the world now. There is a residual uncertainty we can't take away. But what we can take away is uncertainty about where inflation is going to be at that type of horizon. And that's the biggest contribution we are and can and are making.
Thank you very much, Ms McAvoy. John Grady, MP.
Thank you very much, Dame Meg. If I may start with Ms. Greene, because you wrote a very interesting paper or gave a very interesting speech at the IOD a few weeks ago about trade and tariffs. So this week, the President of the United States has imposed tariffs on Canada and Mexico and additional tariffs on Chinese imports, and there's discussion about a 25% tariff on EU goods. How would you explain the impacts on this to a family of non-economists in my seat of Glasgow? What would you say to them would be the 4 or 5 key potential impacts on their lives of these tariffs?
Sure. So I would start off by saying how uncertain all of this is. We've seen things that have been announced that have been delayed or haven't happened. We don't know how anybody will respond to this. So there's a ton of uncertainty that you have to approach this topic with. And then I would think through the different channels through which tariffs might affect the UK economy. And there are a number of them, and they work in different directions, depending on how other countries respond to them. But I would start off by looking at export substitutions. So if there are tariffs on the UK, for example, then UK goods are relatively more expensive than domestically produced goods by the country imposing tariffs. So people might look for alternatives and stay away from UK goods. That would put downward pressure on demand for UK goods, and so would put downward pressure on GDP and on inflation. That said, there might be a bunch of trade diversion as well. So countries that used to sell into the market that's imposing tariffs might not be able to do so profitably anymore. So they might look for other markets for their goods and might have to discount their goods a bit in order to find these new markets. That would put downward pressure on inflation for the UK. The impact on GDP actually isn't clear. If things are cheaper, then consumers might buy more. But at the same time, UK domestic producers might have a harder time competing with those imported products. So that might be a wash on the GDP side. Then you have to look at exchange rates. And to my mind, this is probably the most important channel and also the most uncertain, unfortunately. So, for example, if there were tariffs, unilateral tariffs by a country, by the US, let's say, on the UK, economic theory suggests that the dollar should appreciate relative to the pound. That might be mitigated by the fact that lots of trade is already invoiced in US dollars. But in any case, if that were to happen, that would put upward pressure on UK inflation and growth. If there were retaliation, however, that should put downward pressure on the US dollar. And the opposite would happen. So you would see downward pressure on UK growth and inflation. So like I said, this is a really important channel. Because the dollar is the reserve currency, it's unclear what would happen. We saw tariffs imposed yesterday, for example, unilaterally, and the dollar actually depreciated relative to the country's currencies that it imposed tariffs on. So this is highly uncertain. And then there are just a few other factors I would think about. One, if you have trade fragmentation generally, you could have the reordering of supply chains. We saw during COVID what that does to growth in GDP. It pushes down on growth, pushes up on inflation. You also have, as a result of trade fragmentation, less kind of knowledge sharing and competition, so that should push down on potential growth. All else equal, that would be inflationary. So there are all these different factors that you have to consider. What I tried to do in my speech was to use a model that I borrowed from the ECB to kind of net them out. And ultimately, it seems likely that the implications for growth are fairly clear. It seems like tariffs would push down on growth. The implications for inflation, which of course is what we're interested in primarily, are much less clear. Net, if you think that exchange rates behave as the theory suggests, then ultimately I think that should push down on inflation, but that's a key uncertainty.
Now, the struggle we all face here is we're trying to look into the future, and none of us are perfect at that. But would my layman's reading of Table 1 in the Bank of England MPC report at the section on the potential effect of tariffs, box C, simply be right that is ultimately the balance of risks are that we don't know what it will do to inflation, but this outbreak of tariffs and the potential for a trade war will lead to lower economic activity in the shorter and the longer run, and less money in the pockets of my constituents in Glasgow as a result. Is that where the balance of risks lie, would you say, Ms. Greene?
Yeah, so accepting there's a ton of uncertainty around this and choreography is everything, it does seem like ultimately there are more things that push down on activity for the UK than would push up, and the implications for inflation are much less clear.
And as a quick fire round, because I don't want to get into trouble, Professor Taylor, would you agree with my reading of the situation that the downside risks for money in the pockets of Glasgow constituents are higher than the upside risks?
I don't think it's just true for your constituents. I think it's true for people around the country and around the world. So I think the governor has also emphasised this, that it's much clearer to try to understand the effects of tariffs on activity and on our well-being and on our output and our wages than it is to understand on the directionally on inflation, because that depends on many more factors. So I think, in theory, are there certain circumstances where tariffs can make you better off? Yeah, but they're very limited. Like, you're a large country with some monopolistic market power kind of situation. That, of course, doesn't apply to the UK, really. So in that sense, if there are just frictions being imposed by other countries, to the extent that we're caught up in that, it is going to reduce our opportunity to use trade. We're a country that trades a lot. Trade is, in a sense, another form of technology. You put goods in, called exports, and some of the goods come out, called imports, and that reflects comparative advantage, and it makes us better off in various ways. Mm-hmm. If you put sand in those wheels, then we're going to be worse off on some margin.
And a question for the governor. Against this uncertainty, if the US imposed tariffs on the UK directly, what would be your three biggest concerns?
Well, I think you'd have to see that in the context of the whole world, by the way. Mm-hmm. So I very strongly agree with my colleagues on the effects of this. Look, I would say to your constituents, trade supports growth. Openness supports the spread of innovation, it supports the spread of ideas. Glasgow became a great city in the 19th century on the back of trade and the Industrial Revolution. You spend a lot more time in Glasgow than I do, but
you're always welcome to come.
So I'm very.
He's buttering you up, I think, Mr. Greene.
But look, and Alan, by the way, Alan's written on this stuff.
Very well.
Alan is an expert. He's written on this stuff. But you go around Glasgow, you see the evidence, you see the buildings, that this led to. So trade supports growth. Now, you're right, as Alan said, and Megan said, that we had the experience, obviously, in recent years of the threat to world security, the breaking up of supply chains, and it's perfectly reasonable to say, doesn't that cause us to reassess this sort of just-in-time world trade economy? My view, however, is that doesn't take away the benefits of trade and diversification. It means we have to sort of, in a sense, take that into account. And the final point I would make is this, and what does the UK do? I think the key point we make is that the place to solve these problems is in multilateral fora, where the UK and others, I was in South Africa at the G7 and the G20 last week with the Chancellor. That's a point I made very strongly. If we're going to solve these problems, if we're going to solve the fact, there is a genuine point about balances in the world economy. China has to answer the question, why is domestic demand so weak in China? And the counterpart to that is a very large current account surplus. Germany has the same issue, although in the last 24 hours Germany has done something quite radical, and we may come on to that actually in terms of the impact it's had today on markets. And the US has to answer the question, yes, you've got a current account deficit, you've also got a very big fiscal deficit, and you're financing that current account by external capital. Alan's written a book on this subject, so I defer to him. The place, if you want to, if you think the world economy is somehow out of balance, the place to address those balances is in a multilateral forum, not by bilateral action.
And you gave an interesting speech on this at King's College in Cambridge a few months ago, so we might as well turn to that. Now, trade disputes are ultimately litigated at the WTA, which is a global institution.
Well, increasingly less so, I'm afraid.
And less so, you're quite right there. And two others are the IMF and the World Bank. There's been some discussion about withdrawal of the US from the IMF and the World Bank. How damaging would you see that to the UK?
That would be a very damaging thing for the world. I really hope, and I have, the new US Treasury Secretary has said that he believes in multilateralism, and I, strongly welcome that. One of the most, I think I said in the speech in Cambridge, the world economy has changed a lot since Bretton Woods in 1944, but the most lasting contribution that Bretton Woods has made is actually the creation of the IMF and the World Bank and the multilateral institutions. Now, it is true to say that Bretton Woods was designed in a world where obviously it was designed during the Second World War, but it was designed in a world where the US was actually the surplus economy. The UK sterling was the reserve currency. And a lot of the tension, you always read these books about the tension in Bretton Woods between Keynes and Harry White, who was the US leader, led the US side, and it was about how to balance the world economy. But the reason I say that is that, from the early 1970s, or from the 70s onwards, the US changed from being the surplus economy to being a deficit economy. The Bretton Woods system it was designed asymmetrically, actually, by the US, so that the adjustment occurs in the deficit economies, not the surplus economies. But the US then, ironically, has become the deficit economy. So, there's a perfectly reasonable question, although it has been addressed many times without coming up with an answer. Well, do you need to think about how this multilateral system works, given that change? But what is essential is that we don't abandon the multilateralism. That's really essential.
So in summary, you would say that we need to make sure that we keep, Martin Wolf's words, mediation internationally between the grasshoppers and the ants, is his famous essay.
That's a very eloquent way that Martin's put it, as ever.
And in your view, is this, with your kind of historical perspective, Governor, is this a passing storm, what we have going on at the minute, or do you think it's reflective of much greater turbulence to come?
Well, Alan said earlier, what are we going to end up calling this episode and how big is it going to be? I mean, it is a big episode, actually. It really is a big episode. I think it's a very, there is a major shift going on there in terms of certainly, obviously, in the US. So we have to take it very seriously. We have to address it, and we have to be prepared to address it. And I welcome what the government's doing on that front. So I think we do have to we have to dig in at this point and say, how do we address these issues satisfactorily? We can't ignore them, frankly, at that point, because otherwise, the risks, as I think all of us have said, and the risks to the UK situation, to UK growth. Megan's right, I think, to make the point that the impact on inflation could be ambiguous, but the risks to the UK economy and to indeed the world economy are substantial at that point.
And that means the risks to people in England and Wales and Scotland and Northern Ireland having less money in their pockets ultimately.
Well, yes, I mean that's right. We have to take. Well, this is what we're here for. We serve the people, and we have to take it very seriously.
I think that's enough from me, Dame Meg. But
thank you very much for now, Mr. Greene. Ewan Yang MP.
Thank you, Chair. Dr. Pill, I appreciate the comments you and your panellists have made on the uncertainty facing the future trade tariffs and trade deals that are on the table. I just want to ask a really specific question, which is, in the event of the threatened steel and aluminium tariffs launching into effect next week, what is the kind of game plan that you and your team of economists have right now to monitor that situation and the potential feed-through to inflation in the UK?
Well, I think as has been said, and I think as is reflected in the box in the NPR that's been referred to, I mean, we would need to work our way through the specifics of all of this. So, I mean, there are many of my colleagues are examining the various options here. I think the crucial element, which was the one emphasised by Megan, is that we have to see this through the lens of the system as a whole, not just through the lens of what any bilateral relationship may or may not be. And indeed, our bilateral relationship in that area with the US is modest, but in a multilateral context where we are importing from other parts of the world, how they respond to developments on one side of the Atlantic versus the other, or indeed across the whole global economy into Asia, this becomes the sort of key question. And I think that does get to the importance of understanding things not just through their direct effects, but their overall effects. And in particular, for example, as Megan has said, if we were to see trade diversion, so countries that are unable or no longer competitive in exporting to certain parts of the world because those parts of the world have imposed tariffs on their specific goods, would that lead to a diversion into other markets, possibly including the UK market? And that's the sort of uncertainty that I think would influence the short-term outlook for inflation through this route. Of course, those goods are important inputs into many parts of the economy, and so that would have ripple effects. But what I would emphasize, and actually goes back very much to what's been said into the previous question, is those short-term ambiguities about what happens to inflation. It's also true that, like, fundamentally here, all these disruptions are disruptions to the efficient sort of allocation of production and information sharing and capital across the world. And those types of things are what going to undermine productivity growth. And productivity growth is the most important driver of the supply side of the economy, as Meg and I referred to earlier, and also to the living standards that we all enjoy.
You mentioned measures that you're already taking. Can you name some of those specific measures, for example, to pick up on the effects of trade diversion and so on? That have you changed any methodology of evidence gathering? Are there specific measures that you're taking?
I wouldn't say there are specific measures. We are collecting information. We are always looking at this information very closely. We look very closely, as a general rule, at developments in import prices by sector, and we trace the impact.
You're not changing any modelling at this point?
We haven't changed modelling at this point, no. I think that's...
Thank you. Dr. Stevenson.
Thank you very much, Chair. Governor, I want to ask you some questions around monetary policy transmission, the decisions you guys are making in the Monetary Policy Committee, and specifically its interaction with the APF and its current reserve policy. I think you spoke about this a bit before, but I do want to get your views on this a bit more clearly. I suppose, just say for the room, indeed those watching, that at the moment the Bank of England, rather commercial banks, hold reserves, and the Bank of England remunerates those at the base rate. So when you cut the base rate to 4.5, then that's the reserve and that's the transmission mechanism. What's your view on, if you like, paying the policy rate on all the reserves, its impact on monetary policy transmission, but specifically around this time when you have the APF as well operating?
Well, I think paying bank rate on reserves is the simplest and most efficient way to anchor the short end of the curve. If you ask the question, when we decide in the MPC what bank rate is, what do we actually do? Yeah. Well, what we do is, as you just said, is to change or not the rate we pay on our reserve accounts. That's the thing we do, and everything else sort of follows on, as it were. It's a sort of follow through from that. So it's the anchor, if you like, of the very short end of the interest rate curve. And then the monetary transmission mechanism follows. So it is the most efficient way of doing it in that sense, in my view. And I think it works. It's a system that works efficiently. Now, that's the answer to the first part of your question. So you mentioned the APF, which of course is the QE/QT sort of piece of the picture. That's, of course, that's separate in terms of the rate we pay on reserves. The thing I would say there, stop me if I'm interpreting the question wrongly.
Clarify if that's helpful. Is it helpful if I clarify?
If you like, yes.
Yeah, so I suppose my concern is that there is at least two mechanisms by which paying the interest rate on reserves fully is actually damaging the monetary policy transmission mechanism. So the first of those is that on the one hand you raise interest rates as the MPC and that gets paid out on all reserves. Commercial banks receiving that interest rate, but now they're receiving, if you like, a windfall payment that they weren't expecting. So on the one hand, you're raising interest rates, which are supposed to reduce the money supply, and on the other hand, commercial banks are receiving more payments they're expecting, increasing their liquidity position. So we've seen, for example, the big four banks' profitability up from 45 billion, up from 25 billion, almost doubled. I think Sir Paul Tucker has it at 42 billion interest payments as part of the APF. So they're working in two different directions, and that's my concern. So on the one hand, the efficiency in the reserves, but on the other hand, this particular moment.
Could I say two things on that? I've quite often been asked in the past at this committee about the way in which our interest rate changes pass through, particularly into the interest that depositors earn on their accounts. Well, that's all part of the same system, because I go back to a speech. I made a speech at Loughborough University just over a year ago, where I tried to set this out. The banks essentially have to target, they target what's called their net interest margin, because they have to. They have to earn at least the cost of their capital, and a big part of that is the net interest margin. So that sort of neutrality on the reserve accounts, in other words, we pay them the bank rate, but we expect them to pay out on the other side of it. No, they don't pay the whole. I know the rates do differ, but the point is, if we didn't pay them that, you would see that coming through into deposit rates, because they do have to earn a net interest margin, which reflects their cost of capital.
I get that. That's not quite what I'm getting at, Governor. What I'm saying is that the banks have got a better liquidity position they're expecting. In fact, they've had an unexpected windfall payment, because in 2021 they're expecting interest rates to be 1%. What they've then seen on the other side of it is all of a sudden these reserves that they hold all of a sudden pay 4.5%. So they, if you like, are receiving a lot more money each time you raise the interest rate. We also expect them,
if you think about their balance sheets, the reserve accounts that they hold with us are an asset for them. It's a liability for us, asset for them. They, on the other side of their balance sheet, they have customer deposits, for instance. When we raise the interest rate, the bank rate, their customers expect to earn a higher return on their deposits. You can't just see it as a windfall for the banks in that sense.
No, but it's only a windfall because of the APF, right? Because the reserve payment, the difference in bond payments, that's why it's becoming a windfall for them, right? So you're paying out this money to them. They're seeing their liquidity position expand. But this isn't just me, right? So my question really is about what the Bank of England has done around the monetary policy transmission mechanism. Have you made, in the Bank of England, an empirical assessment by which, if you like, this mechanism by which you're improving liquidity or the asset equity position of banks through the reserve payments and is having on monetary supply, have you made an impact which is damaging or indeed impacting monetary policy?
I think the APF is quite separate, if you don't mind me saying so, in this sense. So we do spend a lot of time studying the monetary transmission mechanism. Our staff spend a lot of time on it because it's crucial to understanding, as you said, monetary policy. Because Hugh talked about the restrictiveness of monetary policy and the restrictiveness of our current stance on monetary policy. Well, a very important way which we assess that is through the monetary transmission mechanism. Is how is it working? So we do spend a lot of time on that. The other thing I would say is that, can I just say, these reserve accounts are there for two purposes. One is monetary stability, the other is financial stability. So we also have to be very careful about the financial stability position, because going back to the pre-financial crisis period, I'm afraid the error that was made in that period was that we had a stock of reserves which was much too low from a financial stability point of view. So we do run a system which maintains a stock of reserves which is consistent with both monetary policy and financial stability.
I agree with maintaining the stock of reserves. I think it's a question about where we are specifically at the moment, and the specific question I had was around the empirical assessment, because it isn't just me. Look, I've at least 2 CPR papers talked about this damaging effect, and their empirical assessment is that actually by not having some tiering of reserves, that at this point in time, because of the reserve payments going the other side, because banks are seeing more payments and lending more out, that actually you are having a situation where it is damaging the monetary policy transmission mechanism. So my question is, has the Bank of England made any assessment of that or empirically done so? Or is there any plan to do so in the future?
Can I suggest this? We spend a lot of time on the monetary transmission mechanism, but I'd be happy to go back. We'll look at those 2 papers, and I'm happy to write to you.
Thank you very much, Mr. Governor. We appreciate that. Dame Harriet Orban, MP. Thank you very much, Chair. And my questions are for Dr. Pill. In terms of the 12 recommendations from the Bernanke review, could you just update the committee on how many of those recommendations you've already brought into your decision making, how many are ongoing, and are any of them proving to be impossible to implement?
A lot of work has been started and is being conducted in the aftermath of the report to implement those recommendations, which, as you say, have all been accepted. What I would say, and indeed I've said in some of the public communication I did last year, I think it is important to recognise that the strategy we have is a little bit like an iceberg. There is a lot going on beneath the water level, which is not visible to the outside. And I think probably the fruits of the efforts that are going on there will only become visible in the course of this year.
That's the opportunity you have now to tell us what's going on at the bottom of this iceberg.
Well, The reason I say that is a lot of what's going on is probably the necessary foundational activities before the things that perhaps are more of interest to this committee can be done. So that is about setting up teams to address some of these things. It is about improving our data and IT systems to be able to introduce new modelling frameworks and represent more effectively the output of those modelling frameworks, both internally and externally. And of course, that's a natural precursor to improving the decision-making process along the lines that Professor Bernanke suggested, and then ultimately leading to how we might change our communication of policy. So there's sort of a natural sequencing here, where moving one part of that is both necessary before you can move on subsequent parts of that chain, but also is very interconnected with subsequent parts of that chain. So I think there is quite a lot of preparatory and organizational work that is taking place, which is, shall I say, less glamorous and perhaps of less interest to you, but is extremely important to ensure the success of the overall project.
So have any of the recommendations become part of your way of working? I mean, you referred to the scenarios earlier, and I thought that they might be linked to the Bernanke review.
Well, I think it is certainly true. And for example, when I spoke last July, as I said earlier, when we began to introduce this notion of cases that came up earlier, I think those were introduced a little bit in the spirit of the scenarios Professor Bernanke had pointed to. I think it's also fair to say that they were introduced a little bit in the mode of experimentation rather than this is the answer to which the essay question that Professor Bernanke posed us. And I think that is in the spirit of how I would see quite a few of the things that have happened, for example, in the way the monetary policy statement has been written. It's shorter. That was one of the Bernanke recommendations. It focuses less on the central forecast published. It's more a narrative discussion of where the economy stands. So I think we have made progress in implementation, but I would say that it's probably important to emphasize that I wouldn't want any of the innovations that we've made to be seen as a definitive answer to one of the recommendations. I think we should see it in the whole rather than...
When can we expect the recommendations to have been adopted by the bank?
I think that is a progressive process. So I don't think there will be a day where we will say we are going to introduce 5 of the 12 recommendations today in a way that we have not done in the past. So the work plan that has been set out is a work plan that envisages what is called in the bank an agile approach. So an approach where there is some experimentation that is embodied in the decision-making process. It is maybe embodied also in the public communication.
The work plan.
The project that we have set up, and of course this goes to budgets and things that my boss sitting next to me is in control of. I mean, that is a 3-year project.
3 year, okay.
My own view of this is that we will make and are making significant progress. But for me, a key message of the Bernanke report is that there are dangers in becoming complacent, thinking you have solved the monetary policy problem. And the challenge really posed by the recommendations is to ensure we develop a kind of learning and innovative culture in the bank to ensure that we don't fall, if you like, behind the efficient frontier of producing monetary policy decisions, which I think we may have done in the past.
I think that's probably enough on the Bernanke report today, and we can
we'll
come back.
It's an area we can keep watching. Thank you. Bobby Dean MP.
Thank you. I was fascinated by the discussion at the beginning, and perhaps the first question directed to you, Professor Taylor. We were talking about the underlying disinflation and the second round effects and the general uncertainty, but the forecast inflation now is to peak at 3.7%. That would trigger an exchange of letters with the Chancellor. And so people might be surprised by the lack of alarm over the resurgence inflation. Can you explain that, why there's not more alarm about inflation?
Alarmed by me or by everyone else?
Well, everybody else might look at those figures and look at what process that triggers and think, well, aren't we just back where we were before? And I know you went to explain that a little bit in your answer earlier, but if you could you give us more context why there isn't more alarm from it seemed from the MPC about inflation?
So, I mean, for myself, I said in my answer of what influenced my February vote that on the concerning side was this change in the path of inflation. It was forecast to rise to around 2.5 in the November MPR. Now it's going up to 3.7. So what's the delta? What made that change? A lot of it is energy, right? So I think Ofgem is like 0.4 out of the roughly 1 or 1.2. And the other things are what we spoke about, the administered prices and the bus fares and the VAT and so forth. So that's another shock of the same flavor as the energy shock we had before, but much smaller. And interestingly, we were looking at the gas curve and the gas prices, spot prices today. They're down to 104. They were as high as 140 a few weeks ago, reflecting geopolitical developments, though, of course, to overuse the word we've been using all day, there's a lot of uncertainty about what comes next. One can imagine a future where gas prices stay at 104. Pre-pandemic, they were in like around 40 or 50, right? So what is the normal level? And what level will they get to? Under what geopolitical state of affairs will they get to that level or not? Or will they shoot back up if there's some adverse shock? So, historically, some of those energy prices are largely unpredictable, and the curve may not be a very good guide. So one way to look at that is it's gone up. It went up before. There's some reversal. Many of these shocks will fade at the horizon that's relevant for monetary policy, and there'll be price level shocks, but we don't have a strong read on a directional trend, and we hope there isn't one. But then for the others, the non-energy component, water and bus fares and VAT and so forth, those are very much in the flavor of one-time tax increases, if you like. And so there, it's not like we say that's demand and supply pressure in the economy. It's a sign that the economy is running too hot and there's inflation being pumped in from those economic fundamentals. That all being said, I listed that as a concern, which balanced, in my vote. And I think if going forward, it started to show up in any sign of second-round effects, or if it started to show up in expectations, then you'd have to take pause. But as I also mentioned in my answer, there could be a million other things going into the take pause bucket or into the other directional bucket of saying, rates might need to go down slower, they might need to go down faster. That was the flavor of Deputy Governor Dave Ramsden's speech in South Africa last week. So it's one of many factors. Maybe all the factors are alarming.
Can I add something to that? No, I agree with what Professor Taylor said. I would just say, to my mind, there are a few key differences between this near-term increase in inflation and what we've had recently in the past. One is it's going to 3.7%. That's not 11.1%, right? So it's a smaller increase, but also just as importantly, it's happening in a very different environment where the labor market's broadly in balance and is actually loosening as opposed to tightening. And of course, I think monetary policy is restrictive, which it hasn't been in previous recent spikes in inflation. So those are key differences, but I wouldn't want to give the impression that we're completely sanguine about this near-term increase in inflation. I mean, the academic literature suggests people don't pay attention to inflation unless it's 4% or higher, but of course, given what we've just been through, it is possible the threshold for that is lower, and people are a bit more sensitive to inflation, and that's something we're certainly looking out for.
I completely agree, and I think it's those things like, is salience up? Maybe. Is slack up? Yes. We're going to be looking at all the indicators. That's why I said I think our meetings are going to be very live, because we're going to be watching in real time for those kinds of signals.
Okay, perhaps I can turn, thank you very much, Mr. Dean, to Dr. Pill, because this is the second consecutive increase that we've seen. And do you think, it's interesting, Professor Taylor's articulated very clearly the different types of the different reasons, and so some of those are sort of one-offs, so therefore short-term. Do you agree with that, or do you think there's a risk that there's just an underestimation of the risk of inflation going up?
Well, I think you can have both, and I think that's the concern. I would share a lot of what's been said by both Professor Taylor and Megan on the discussion of the impact of these one-off effects that we do expect to see and have been the main reason why the short-term inflation forecast looking to the middle of this year has risen substantially in the February MPR relative to the forecast the MPC published last November. And I think it is relatively mechanical, given developments in wholesale gas futures markets, developments in water bills, and so forth. Those feed through in a pretty predictable and mechanical way into short-term movements in headline consumer price index. For me, the short-term challenge of that is not whether that will come through, it's more to interpret, does that trigger these famous second-round effects? And I think that's a concern. But I would say, and I think this is perhaps where there is a bigger distinction between what others think, or variance of views across the committee, I think it's a bigger distinction about how much of the echo effects, as I described earlier, of these big inflationary impulses that took place post-pandemic and with the invasion and the big rise in energy prices that took place in that context, how much of that is still to be squeezed out of the system. So personally, I think that we don't yet, I personally do not have yet full confidence that we've squeezed all of that out. So there is a question.
You're saying really it's historic impact, so you're not worried about the 25 price shocks to the same extent. You seem to be saying that you're minimising that, but those long-term shocks are still.
I'm not sure you can separate them in quite that way, but what I do want to emphasise is that even if I was reassured, and Professor Taylor has made the point that wholesale gas prices have actually fallen quite a lot over the last week or so on the back of information associated with geopolitics that we all know, that might mean that the outlook for mechanical dynamics in short-term inflation forecasts, say going into the third quarter of this year, that could be lower than we had in the February projections, perhaps to the 0.2, 0.4, not dramatically lower, but nonetheless lower than we might have had. I mean, in that case, would I then say sound the all clear? I would be sceptical it was the moment to sound the all clear, because I think these underlying need to maintain restriction in the system to squeeze that dynamic in inflation, which has been quite persistent over the last couple of years, has not yet been fully rooted
maybe
out.
Just maybe I'll ask the governor, and appreciate that you might be constrained in what you can say as the governor, but you've got future rate setting meetings. You've got these shocks that have taken place this time. And Professor Taylor and others seem to agree that they're one-off. Not I'm paraphrasing massively, but one-offs that are not like to have a long trend. When do you think you'll know that that glide path to 2% is secure? And have you got any estimate in your mind, or are you thinking at all about how these world shocks that we're going through?
Difficulty is, of course, the world keeps moving.
Well, indeed, because you're on a glide path and then you held for a bit, and then.
I suppose the one thing I'd add, I agree with what he just said. Actually, the one thing I'd add, of course, is to bring it back to this question of the balance of supply and demand, because that will influence the answer to the question that Hugh has just sort of, in a sense, outlined very, very well, which is how our judgment will evolve, because the balance of the contributions of supply and demand, put simply, is it demand or is it both supply and demand, will shape this question of the evolution of underlying inflation. Now, so far, as I think I said earlier, we're seeing sort of gradual downward progress. As Hugh said earlier, we're seeing frankly better progress than the record of the 1970s or early 80s would tell us. So that's good news, and that's, I think, large part down to having these frameworks, having nominal targets and so on. But how it evolves from here will very much depend on that. Now, and this is why there are two-sided risks. I think we are at a point where we certainly had supply weakness last year. I think we are, as Megan said, the labour market's in balance, but signs of it probably continuing to weaken in some of the surveys. Not really yet, though, coming through into pay. Our judgment on pay is relying, as Alan was saying, a lot on the sort of the agent survey, which, by the way, is historically a good indicator. But to answer your questions, I think those are the things that are going to shape the answer to the question of, how's our... I don't think there's going to be a light bulb moment when we say it's all over, we're going to
What I'm getting is a session that there's uncertainty, but there's not panic. Right?
No, we're not.
Panic is probably word you should never use in the Bank of England.
I'd like you to think that you don't want the MPC to panic.
No, indeed. Perhaps that was the wrong word. But you're all very relaxed about the fact that all of these global
seriously.
You're not. But you're taking seriously these global challenges. But you're still confident that glide path to 2% that Ms. McAvoy was talking about is
yes.
You're on that
at the moment. But look, things can happen, as my colleagues have said. But I think the underlying path is still downwards. And I pointed to sort of core services inflation earlier as not a bad guide to that. So I think the underlying path is down. I think, if anything, probably my own, this is personal view, I think probably the demand weakness argument may be getting a bit stronger relative to last year, but we'll see.
Taylor, did you want to come in on this point? Very briefly, please.
I think there are reasons to be worried about both sides, as I've said before. I think it will come back to the state of the labour market and wage inflation, which is an important component in the price of services. So on a lot of that, we've got backward-looking information in the AWE, which had that kind of strange trajectory. But now we're going to get readings coming in. And those are the wage settlements for this year. So in a sense that in January...
Real data, yeah.
Right, in January we had the agent survey, which gave us a number, 3.7, and that was based on data collected over several months. Now settlements are rolling in. Not very many, but a few. Most of them will come through maybe in March and especially April. So an interesting exercise which I did with my research team this week, was to say, let's scroll back to last year, and then how did wage settlements unfold over those 4 months? And what have we got so far this year? And it's interesting that what we got so far, and it's a small sample, is coming in right on where the agents have said. But if you go back to the corresponding months last year, January and February, and you said at this point, this exact day a year ago, what would we have known? Those numbers were coming in at the high end of the agent's survey for last year. And in a weakening labour market, as the months progressed, wage settlements came in at successively lower numbers. So the early numbers were above the mean, the later numbers were below the mean, which is what you would expect in a weakening labour market. Now, there's no guarantee that that pattern will unfold this year. It is still a weakening labour market, though. But so far, we've got a number that gives me reassurance that what the agents said, so far has unfolded fairly accurately. So that's the kind of information we'll be following in real time, which will be a better guide for us at this kind of inflection point and point of uncertainty than just relying on those backward-looking numbers.
That's really, really interesting. Thank you. Chris Coughlin, MP.
Thank you. Dr. Pill, at the beginning you were talking about inflationary echoes still being there, avoiding the mistakes of the 70s, but wages are rising, productivity is falling. Isn't that quite a strong inflationary indicator? So how worried are you about actually maybe we could repeat the mistakes of the 70s of easing monetary policy too fast?
So thank you. Yes, just to emphasise, and your question is a good prompt for this, is my position on this is I think we are on the glide path, and I think the scenario you are just painting is a scenario that would say we are no longer on the glide path. If I thought we were moving in the direction of being no longer on the glide path, I think that would require quite strong and immediate action. So it would lead me to depart from the sort of gradual, cautious dynamic. So I do see, back to the Bernanke story, that is a different scenario. So the way I'm interpreting the data now is, yes, in the big picture, and that's kind of why I tried to start with the big picture, we do see quite a lot of volatility month to month in some indicators rather than indicators. We may get to discussions of challenges with some of the data we are using. So I wouldn't want to be beholden to any single indicator in any single month. And I think we have tried to shift our communication away from the sort of key indicators that we were talking about 18 months ago, more in the direction of these cases or scenarios, precisely because we want to tell an economic story. And the economic story I would want to tell is a story not dissimilar to that you just heard from Professor Taylor, is a story that, yes, there is an easing in the economy. That easing in the economy is reducing pressure on resources and allowing core services price inflation and pay growth and margins all to weaken. And that is consistent with moving the dynamics of those indicators back to rates that would be compatible with the achievement of the 2% inflation target on a lasting, sustainable basis. So, that is, I think the discussion in the MPC now, as I read it, is a discussion about how intense are those disinflationary forces. Yep. And the glide path, therefore, becomes a question about how fast can we follow down. I think it's fair to say, and this is what I've tried to articulate earlier, I am on the side of saying, well, it's not that I'm doubting that the path of interest rates, bank rate from here is going in a falling direction, but I would err on the side of caution. Now, to your point, I mean, it is true that we have seen weak productivity growth. It is true that we've seen headline AWE, average weekly earnings, regular pay growth in the private sector rising in the last few quarters. I mean, we have quite a lot of information looking at other indicators, cross-checking and so forth. I think there's, in my language, plenty of reason for caution, but it hasn't yet accumulated to enough for me to change the scenario that I would see as the base.
You're all
case.
Confident that you're on the glide path, depending on how steep that path is, depending on where you're the cautious or the less cautious. Thank you very much indeed. Rachel Blake, MP.
Thank you, Chair. We've had a bit of a discussion about energy prices and their role with inflation. It's been established today that the volatility in energy prices is now certain, and it seems to me that the volatility is essentially baked in. What, if anything, can MPC decisions do to tackle energy prices?
Well, I'm afraid the influences on energy prices are, we would come quite low down in the list,
That's
put it
what
that
I
way.
thought you would say.
Okay, great.
Yeah, good. That's what I thought you were going to say. Good. So we're all on the same page there. So therefore, what are the drivers that you see?
Of energy prices?
Yeah.
Well, I think, Alan could say very well, we've seen, I think between the November monetary policy report and the February monetary policy report, they went, talking about gas actually here, because actually gas is very salient for obviously the UK household consumption. I think the spot price went up about 20%. Since we did the February monetary policy report, I think it's come down about 10%, mostly in the last week, as I think one of my colleagues was saying. That's the world we're in. Two or three things have influenced that. One is obviously the geopolitical situation. I think particularly in the last week, obviously the greater prospect of, I hope, of peace coming in Ukraine. We've had a colder winter this winter in Europe. By the way, I'd use Europe geographically here. It's important because it is actually a single gas market, which we're part of, so the European price is relevant here. One of the things that actually benefited us in the last 2 years was that the first two winters after the Ukrainian war broke out were actually warmer in Europe than on average. This one hasn't been. And then there have been some further supply disruptions, partly to do with Ukraine. So those are the things that pushed it up, weather and supply disruptions, the prospect of, hopefully a greater prospect of peace in Ukraine seems to have had a beneficial effect on the price in the last week or so.
Professor Taylor, did you want to add?
No, especially. I mean, obviously, it's very far from anything under our control, the price of energy, and it's a big exogenous driver of inflationary pressures. It takes the form of gas now. 50 years ago, it took the form of oil, but it's a very big component in the economy. The economy runs on energy. If we were to live in a world with stable, certain, reliable, well-buffered energy in our economy, then probably our job would be easier.
I'm really pleased to hear you say that, because that leads on to my next question, which is about the point at which government investment in renewable energy might start flowing into energy prices, because clearly the government intention is to invest in renewables to stabilise our energy costs and to secure us nationally. At what point do you think we might be able to see that stabilising these prices, which should then start to affect inflation?
Well, I'm not an engineer or an expert in that area, but I think it is interesting talking about the inflation target and ways of actually setting up the regime and thinking about the long-run history of attempts to achieve price stability. It has been for, in the last 50 years, the only two times we've seen a big test of inflation stability has been in the face of energy shocks. I mean, those have been the big tests, and they've left imprints on the economy in our society. They've made people very unhappy, and I would say they've reinforced the demand for inflation stability that has, fed through into the current MPC arrangement, our current the independence of the central bank, the inflation target we've been mandated to do. So I think, that history speaks to the major risks to our inflation outcome.
I think, if you don't mind, there's two things on your question. One is, and I'm afraid we're not experts on either of these questions, so I'll pose the questions. I'm not sure I'm going to answer them for you. One is the lead time on any investment to come through, obviously, into productive capacity. We're not the experts on that. The second one, this is definitely a question you should put to Ofgem, because we're not the experts on that, is then there is this sort of marginal pricing system in energy, so that if you have a whole bunch of sort of different sources of energy, if you ask them, well, how do you arrive at the overall cap? I think there's a marginal pricing system, and we're not the experts in saying, well, when would that change?
I mean, just on that, I think it is important to see that, in fact, there's a very, very mechanical dynamic in the current system. So gas price futures evolve the way they evolve. There is a mapping from gas price futures to the off-gem variable energy tariff. That is very mechanical. So we just heard on the 23rd of February what that would be based on futures prices, etc. And the way that is currently treated in the construction of the CPI index that we target is the treatment of utility prices, which are about 4.5% of the total basket, is that variable rate tariff.
I think the question also was, if I were to Rose, how much renewable do you need to sort of, in a sense, change the shape of the off-gem cap setting? I think that's a question. It's a really good question, but we're not the experts on that one. Yeah.
Until and unless it changes that chain,
you can't factor it in. It's an unknown. It's a known unknown at this point.
So it's still too unknown for you. You're not the experts and you're not engineers, but you are looking at prices a lot. But what I'm hearing you say is that it's not seen at this point that the stated desire for investment is not flowing through into any stabilisation. That's what I'm hearing.
Into your forecast.
Well, it also comes to the first point I made, which then you have to sort of factor in the lead time between investment, obviously, and coming on tap.
Even if the forecast, there's a lot more variables. Okay, thank you very much. Chris Coughlin, MP.
Thank you. Mr. Bailey, how worried are you about the fall in UK productivity in the last year in terms of its read-through to the recovery in productivity of UK productivity growth and also the impact on the UK's fiscal position?
Well, let me say two things on that. One's a bit longer term, then come back to the last year. So UK productivity growth has been very weak since the financial crisis. So we're talking now 15 years or so. By the way, the UK is not alone in this by any means. It's actually more often than not, frankly, when you look across certainly the industrialised countries. But the financial crisis was really a break in productivity. We had quite rapid productivity growth actually pre the financial crisis. We've had quite slow productivity growth since then. And this is a point I make quite often. If you look at the UK potential growth rate, pre-financial crisis, it was typically 2 to 2.5% a year. Post-financial crisis, it's 1 to 1.5%, and that's where it is today. There's two things that make up the potential growth rate: labour supply and productivity. Actually, the change is much more due to productivity than it is to labour supply. So that's the long-term context. Going back to what I said right at the beginning on last year, I mean, I have to say, in my mind, there is a real question about, we've got this negative productivity growth number for last year, which is unusual, and particularly in the context we had last year. So to what extent this is a product of the real situation, and to what extent it's a product of the way in which the data series are put together, I think is a very important question, and frankly we don't know the answer to that question at the moment.
Okay, thank you. And do you agree with Ben Navarro at Citigroup, who's saying that just a 0.1 percentage point fall in the productivity growth forecast could create a hole of 7 to 8 billion in the public finances?
Well, that's a question for the OBR, really, not for us. They do we actually use that. We use their multipliers, if you like, and their effects. So it's best question that's just best addressed to them.
Sure. And just come back to your opening comments on national insurance. So retail and hospitality businesses in particular in my constituency are telling me it's an apocalypse out there on that. That was the exact word they used. In the budget, I think the Chancellor was forecasting 50,000 job losses from this. That seems fairly low to me in terms of what we're seeing. Or is it too early to say?
That's the best if I just briefly described what we've been doing in the last sort of couple of months in terms of how we've addressed sort of trying to get a hold on this question. And obviously we have the agents around the country, and we all go around the country a lot, and as you can imagine, almost every meeting we have with businesses, certainly I do, this is a question that is prominent. And I think we've said before, but I'll say again, we laid it out in the report. If you think about the channels through, this is an increase in the cost of employment. So the channels through which it can then come through, obviously we could see higher prices, we could see wage increases being lower than they would otherwise be. We could see lower employment, which could either be in numbers or in hours worked, and we could see lower profit margins. Now, in matter of fact, of course, those things are not mutually exclusive, so we can see all of those happen. when we ask firms, that's exactly the answer we get, that they are we'll do all of them. Now, just add to that, a couple of things. Actually, some of these things can happen sooner than others. Prices, wages are stickier than prices, employment's somewhat stickier than prices, and obviously profit margins are, if you like, the sort of residual, if you like, in terms of that. Obviously firms do seek to influence them, but that's where it goes if it goes nowhere else. And in the report and in the forecast, we actually said that we thought the channel, the makeup of the channels would shift over time to reflect that. That's the first point I'll make. The second point goes to your point about hospitality, because, however, having talked about the wage channel, for those businesses that employ more people who, of course, are whose pay is set effectively by the increase in the national living wage, hospitality being case in point, then one of those channels is obviously very much blunted by that. And I'm not saying that in any sense pejoratively or critically. It's an observation that obviously that channel is less open to a firm where it's got more people at the national living wage. Yeah.
Thank you very much for now, Mr. Coughlin. So I think I'll go to Lady McAvoy. Yeah.
Thank you, Chair. So, in the monetary policy report, you mentioned about productivity, and I'm fascinated by this. All of you have mentioned it about productivity in the economy, and I would really, really love to get a straight answer about what is going on, because we have asked several witnesses over the course of this committee, and we'd really like your professional views on what this puzzle, what is causing this problem. So, it says in the monetary policy report, significant uncertainty around estimates of slack in the economy, particularly at a time when the precise factors accounting for weaker activity are not clear. Please, can you elaborate on that?
Who are you directing that to?
To the Governor, and then also to Ms. Greene, just because you mentioned it, well, all of you, I'm just really keen to hear what you think are the factors causing this uncertainty around what's going on.
Mr. Bailey, Governor.
Well, there could be quite a few answers. I mean, I'll offer a few thoughts, and my colleagues will come in on the productivity story. I think it's quite interesting when I said, we were not dissimilar to most other countries, the one exception on the headline number is the US. But actually, when you look at the US, manufacturing productivity in the US is basically as flat as it is here on the money. Says what the US, and this is going back to Mr. Coughlin's question, looking at the last 15 years, but it's true last year. I think what is different in the US is that there is a big contribution in the US from IT, technology, and there appears to be a much bigger contribution from that sort of growth sector in the US. So that may be one part of the story. The second thing, can I come back to the public sector point briefly?
Yes, right, because you mentioned that earlier, and the lack of measurements.
I mean, the ONS released some numbers earlier on, a few weeks ago on this, and it's sort of both striking and puzzling. I think I'm right in saying that if you take the benchmark as the end of 2019, so the start point, so that's immediately pre-COVID, and you compare it to now, under those figures, the level of total public sector productivity is about 8 to 9% lower, and the level of, you grimace, but you're going to grimace even more when I say what I'm now going to say. In the health sector, it's about 17 to 18% lower. Now, the second thing I'll say is it is very hard to measure output in the public sector. It's much more harder than it is in the private sector to measure output. The ONS do it, and I'm not criticising it, they do it in a somewhat different way to other countries, but it is often described as a leading way. They actually try to sort of, in a sense, measure stuff. Whereas the traditional way is you take nominal spending, deflate it, and come up with a real estimate. So there's no assumption on productivity growth at all. But I say that because I think that, and I said this at the Monetary Policy Report press conference, and if you don't mind me saying this in this, I mean, I was accused by one newspaper of what I was told I'd said the public sector was bloated. I'm not passing judgment whatsoever at this point, so please, if you don't mind me saying that. I think there's a real question. Is this real? Or is it something to do with measurement, with everything that's gone on in? And this is it's a pretty, if your question about productivity, it's a pretty critical question, because I got my colleagues to do the back of the envelope and said, well, if you just hold public sector productivity constant going back to end of 2019, or you just put it on the trend it was on going from the sort of over the last 10 years up to then, what difference does it make to total GDP in the economy? It's in the order of somewhere, it depends on the assumptions you make, of somewhere between 1% and 3%, I think. This is not trivial at all. So exactly what's going on, I think, is a big question. I'll now finish. I'll make the plea we always make. We're not the experts on this, I have to say, but it's a really big question.
When you say, is it real or is it a data analysis problem? So obviously we had the ONS come in, and they assured us that their productivity analysis was, they were sure that there was a productivity problem. I think that's fair, isn't it, Chair? And they gave us their absolute confidence that the data that they're collecting is correct. Are there any other factors that could be causing this in the data analysis reading that you're aware of?
Well, I mean, I'll give one. I don't know is the answer. I mean, they're the experts. It's hard to measure the quality of output in the public sector because it's not priced as such. Yes. That's the first problem. The second thing, we had this during COVID. This should have gone away, actually, but take the health sector. Because we do it a bit differently in the UK and we actually count things, so trips to the dentist, surgical procedures and so on, whereas I say a lot of other traditional ways, you take the nominal spend and you deflate it. The problem we had, one reason UK output fell more during the COVID period than in other countries, but then of course it obviously recovered, was that the things that were counted in the health sector of course stopped happening. So we weren't going to the dentist, for instance. Now, that made it look as if output in the health service had fallen, but of course it hadn't, because as we all know, the NHS were absolutely, at full stretch and doing a great job. But it wasn't captured by the measurement system. Now, I just don't know, because I'm not an expert, so it's all very well for me to sit here and say this.
There are plenty of people who crunch health data. So
I just don't know is the answer, what the story is.
Okay, so let's take health to one side, because you've said you're not the expert, but it's very interesting to hear. And from what you've said, we're no longer in a pandemic. People are getting their appointments now, so we should see a rebalancing of those measurements that were previously calculated. Yes. So if we park health for now, the other sectors that where we're lagging behind, what's your analysis on those? So you said it's public sector, but health is 18% behind. But what about, and maybe Ms. Greene or Mr. Bailey, if you have something that you want to add to that?
Well, I was going to say, I think manufacturing productivity in the UK doesn't look very different from manufacturing productivity in other countries, actually.
Okay.
Yeah. So one thing I will say is that there's certainly a question around measurement of productivity growth. But if you're looking at recent data, there are other suggestions that there's a supply issue, right? And we've just reweighted population. So it's not the labor supply. That means mechanically it must be something to do with productivity growth, right? And so we look at a few different things. One is surveys on capacity utilization for companies. They're just below historical trends, even though we've got a small negative output gap. So that doesn't suggest that it's all demand. That suggests that there might be a supply issue as well. We also have kind of top-down measures of output gaps that doesn't suggest additional spare capacity is opening up. So again, that also shows that maybe there's a supply issue. So it's easy to say it's all just measurement. It's really hard. And actually, productivity in the public sector doesn't fully explain why productivity growth was so weak last year. But if you take kind of a step backwards and consider, well, if it's just measurement, then actually you wouldn't think that supply were an issue. But there are other reasons to think that supply might be an issue. It's not labor supply, probably, given the increase in population, so that must be something to do with productivity growth. That gives you no narrative on what exactly is happening with productivity growth, but it does suggest it's probably not just a measurement issue.
Yeah, because surely if we went back and used the measurements worked before 2019, so if we brought those, and we were doing all right then, so we've seen the hit from the pandemic, but then I suppose if we were using those measurements again, it doesn't really explain the sole reason for the lack of productivity, right?
Yeah, and you could argue we've had measurement problems for decades as well.
Do you have anything else you want to elaborate on just on the supply point? Is there anything that you're desperate to say to this committee about the supply point?
I guess there's just one more thing I would say about supply, is that barring a pandemic or a war or something that comes and really hits you in the face, it's hard to explain supply because it tends to be slower moving. We can't actually observe things like productivity in real time. And so it's much tougher to come up with a narrative of the kind that you're asking for, but that doesn't mean that it's not there.
I mean, I suppose the other thing we should refer back to, and Hugh follows this very closely from our side, is this question about exactly what the labour supply is, and the labour force survey, because this, I think, particularly relates to the question of participation in the labour force. So it's a question about how many people are inactive, as it's put. They don't have a job and are not seeking one.
Yeah, and we're going to touch on that.
Okay, we're going to come back, because that is another, obviously, part of this whole story.
And you've obviously been very trenchant in that from the Managers' House onwards. Thank you very much.
Thank you.
Rachel Blake MP.
Thank you, Chair. Just to follow up on the health sector productivity, you talked about whether it's real or a measurement challenge. Within, let's work in the real, let's say that it's real. Is there any analysis around this being connected to complexity of health challenges that this country faces? Not the expert.
Don't think we really are the experts on that one. Yeah. I mean, we do. I do have very interesting conversations, from time to time with Chris Whitty on this subject. But he and others
Acting
really.
Permanent Secretary at the Department of Health.
Yes,
as well.
he really, they're the experts. So fascinating question, but not one we can help on. I think.
Guest them along next time.
Okay, thank you. Yuan Yang MP.
Thank you, Chair. I have a series of questions about the data. But firstly, Mr. Bailey, can I just clarify that I heard you correctly when you broadly said that you, right now, at present, you don't know whether the productivity is real. Is that your broad view? Well,
in my mind, there are question marks around it. So we've had these revisions to population, probably reasonable we get those. They have partly been fed through into the labour supply numbers, but there's still some more to come at the end of this year. Because we know, in other words, of the already announced population increase, it hasn't all been put through into the labour supply. I think the sheer, the unusualness of the position last year, for me, does raise questions about it. It's not more than that.
And when we spoke to the ONS and the National Statistician, Sir Ian, last month, he told us that he was, quote, very confident about the labour force survey. Not very to very confident. How confident are you with the ONS data from the labour force survey that you're receiving right now? Maybe I'll start left-right with Professor Taylor.
Yeah, I mean, there are known problems with the labour force survey. I don't need to rehearse that. I think we could have a better picture if we had, more information. That's always desirable. But there have been independent studies from other sources sort of saying, there could be a range of plausible numbers for what inactivity might be. It might not be as bad as the official numbers. So there's a range there. I'm not an expert in this area. I think it, directionally, I think it's gone in the direction of more inactivity post-pandemic. But I think trying to understand the magnitude, I don't think I fully understand it myself yet.
Are you very confident in the inactivity data?
Moderately.
Moderately. And Ms. Greene?
Yeah, I would say better data is always better. And so we know there are issues. The response rates have improved, actually, over recent months. And so that's something to point to. But also, we don't just rely on the LFS data. And we wouldn't just rely on the LFS data, even if it were perfect. We would always look at a range of
Where's your level of confidence?
Moderately confident.
Governor?
Yeah, moderate. I mean, I think the challenge we have with the point about other data sources is that it's hardest with inactivity. There are fewer substitutes for inactivity. We're very supportive of the work the ONS are doing, which is the right thing to do, no question about that. I have to say, and this may go back to Alan's point about having a range, I thought the work the Resolution Foundation have done was dismissed a bit quickly in that commentary. I'm not saying they're right necessarily, but it's a serious piece of work. Put it that way.
Thank you. It was interesting. The atmosphere in the room was interesting at the time. Dr. Pill.
Yeah, so in terms of high-level response to the question, I am moderately confident, but improving confidence, I would say. I would echo, and I won't repeat, the remarks made about looking at a broad set of data, including unofficial data or data generated by surveys, including ones we conduct ourselves. I think that is important. So the idea that we are unable to form a view seems to, on issues around employment growth and unemployment levels and the state of the labour market. I think that has been, on occasion, overstated. What I would emphasise, and I don't want to put, it's not for me to put words in the mouth of the national statistician, but I think it is true that in the aftermath of the pandemic, we saw participation rates in the LFS fall very dramatically, and we will never be able to reconstruct that period because we have moved on. So there is kind of a Bermuda Triangle element to this. But the ONS did implement this restoration plan.
Yes, we've gone into through this in a lot of detail with them.
And and of course, because of the wave structure, longitudinal structure of these data, the fruits of that plan being implemented last spring will only become
and we have, Dr. Pill, forgive me if I cut you off, but we have gone through this in detail with them.
So it does seem to me that is the basis of that statement. What I would say when we engage, and we engage a lot with our friends and colleagues at the ONS, I think it is important to emphasise that our benchmark for quality is not perfection, because perfection is unattainable. But I think a good benchmark for quality is pre-pandemic level of quality. And we would be sceptical, at least I would be sceptical, and I think my immediate colleagues in the Economist pool would be sceptical that just getting back to this restoration in May will re-establish the level of quality that we saw prior to the pandemic.
So you're sceptical about whether the current measures to improve the quality of data will get us back to that pre-pandemic benchmark.
And so our view, which I would endorse, when I say our, I mean my colleagues, these are my colleagues too, but my colleagues who I work with on a day-to-day basis, we are looking, and we think, in line with the ONS view, that the so-called transformed labour force statistics, which is this initially internet-based survey, that is the way forward. And that is really the way out of this. The transition to that has taken longer.
And I think the ONS would agree with on that particular point. Ms. Young.
I realise, Mr. Bailey, we didn't quite ask you what's your level of confidence right now.
You did say moderate.
Moderately. Yes, moderately.
When you spoke to us in November, you said that we don't know how much faith we can put in the labour force survey, which to me speaks to a level of not very confident back in November. Has your confidence risen since then?
I think it goes back to what Megan was saying. Parts of it we can cross-check much more easily against other data sources. So if you said to me, you're confident on unemployment, yeah, I'm reasonably confident on unemployment. I think the cross-checks sort of seem to bear.
DWP's own figures were
quite. I think it's particularly this question of inactivity and participation, where because there's so little sort of ability to cross-check that one, that I have more questions, put it that way.
More questions. Yeah.
Can I just say one thing on that? There is a letter which I wrote to my colleagues at the ONS, which your former colleagues at the Financial Times.
It's the May 2024 letter.
So in this letter, we set out a set of requests. I think it is fair to say that the reweighting of the LFS on the basis of the interim population estimates, which is what the Governor referred to earlier, I think that has been completed. And also with the move in May, publishing the March data for the post-restoration plan, we will have better flow data. And those two things are quite key to our understanding of the type of analysis we do. For example, constructing measures of the natural, or the non-accelerating, the NAIR non-accelerating inflation measure of the unemployment rate, which are quite key to our forecasting process.
Thank you.
So I think there is I think it would be...
Thank you. Last one.
Satisfied?
I think I am satisfied that they are being satisfied. As I say, I mean, there is a two-sided element to this. We want to see a quality of data which we found acceptable, which is the pre-pandemic quality of data. We don't think the implementation of those measures will deliver that.
Right.
What we do think, though, is that the TLFS is the answer, and in a constrained resource situation, which clearly the ONS faces, there may be needs to put more of the resources they have into this space, and we would, at least I would, endorse that approach. But I do think it would be counterproductive, for example, to expect them to do a repeated interim update of the weightings at the expense of making improve the population weightings based on the interim population estimates we had earlier this year, at the expense of making progress with the TLFS. So, it's a good economic question about how to allocate scarce resources.
You will indeed, and we had that out with the ONS when they were with us. Thank you very much, Ms Young. Dame Harriet Baldwin MP.
Thank you very much, Chair. And the characterisation I would give to the evidence that we've heard today is that we've got a UK economy that has sort of managed to survive a range of different shocks over the last few years, but it's an economy that's really just surviving and not thriving, and productivity, particularly public sector productivity, has not been demonstrating the same sort of levels that we had seen historically. And so I just wanted to probe a bit further in terms of, into this context, we then have a budget at the end of October where a further £350 billion of public spending is announced, funded by borrowing to some extent, but also funded by £25 billion increase in tax on businesses primarily through national insurance. And Governor, you've very kindly sent me a letter, sent the Chair a letter, referring to the questions I asked you last time about the transmission mechanism,
which is published on the website.
Has just been published on our website, about national insurance contributions and trying to disaggregate them, but acknowledging that, of course, businesses will react in the four ways that you described earlier. And I thought it was a very interesting letter because clearly we can observe that businesses are reacting in those four ways. And you highlight in your letter that in terms of taking it on the chin through profits, there's limited capacity for businesses to be able to do that. Am I correct in understanding your wording around that? Is that correct?
Well, I mean, I think I attempted to do the sort of the what-if calculations, which I think was the original question. I should say, I did point this out, I mean, they're all a bit heroic.
I really just wanted to, have I understood that correctly?
So,
is it
I mean,
yes to
I
that
think the point I was
question?
making is, if you did the what-if and said if they all went through one channel, yes, if it was concentrated in one channel, that would obviously be quite noticeable.
And so it's limited as to how much can happen through that channel.
We don't, as I said earlier,
is what your letter
we don't
says.
expect it all to come through one channel, as we said earlier.
And then you've said that there has been an impact in terms of businesses have been able to transmit through or react to the tax increase by raising their prices. You quantify that in your letter at being between 0.1 and 0.2. Is that, have I understood that correctly?
Well, we're still in the world of assumptions, so we obviously put something in the November report, and we really essentially continued that in this report. But this is still sort of very much an assumption. It's not something that obviously we can sort of.
There's been a non-zero impact from the budget on inflation.
Indeed, as we've said, we expect this to show up in an effect on inflation, yes.
And then they could obviously react by reducing nominal wages, and you've said that some of the transmission will happen that way, and you're picking up some of that in your data. Am I correct in understanding that as well?
Yes.
And then the sentence that I thought was particularly interesting in your letter was where you say that because there's a limit to the amount that businesses can pass on through reducing their profits, and it's difficult for them to pass on the increase in consumer prices in full in terms of their costs, that it may point, I'm quoting your letter, to the risk of stronger responses through the labour market. And we can observe that jobs are being cut at the fastest rate since 2008 in the data. And Professor Taylor, your quote earlier was that we've not yet seen major redundancies, but you did acknowledge that there has been a weaker labour market. So, Governor, I wonder if you could put a number further to my colleague Mr. Coughlin's question on the number of jobs that have been lost directly as a result of the budget increase in national insurance?
I can't, because obviously it hasn't actually happened yet. In the sense, obviously, the changes.
It's happened to a lot of people. We've seen a lot of announcements of job losses.
Yes, but I mean, we have to sort of, in a sense, separate that from the general weakness of demand and the economy we were seeing last year, which obviously predates the budget. So I think you'd be a bit careful in that. What I would, and this may be helpful, what I would say is when you look at the surveys that are being released at the moment, there is certainly a weakness in employment intentions in there. So if you look at the purchasing manager surveys, if you look at the recruitment surveys that are published once a month, you can see a weakness. Now, But let me just reiterate the point. We've seen a softening of the labour market going on from before the budget. So there's more than one thing going on here.
But the Office for Budget Responsibility forecast that the budget would cost 50,000 jobs. Is the Bank of England's forecast different from that?
Well, we tend to, in terms of fiscal impacts, we use their numbers, actually, so we wouldn't tend to adopt a particularly different. Obviously, we're interested to see they'll obviously be coming out with a new forecast quite soon now, so we'll see what they have in their new forecast.
Have you seen anything that would make you believe that 50,000 was not a correct forecast? In the data that we've seen so far?
Obviously, what I would say is that when I go around the country talking to businesses, they talk about, as I said earlier, they talk about all the channels, but they do talk about looking at both employment numbers and hours worked as well, by the way, because you can adjust in two ways. So we are certainly picking up that, but that doesn't, you can't easily aggregate that up to say it's 50,000 or it's not 50,000. So I'm going to wait and see what the OBR think on that one.
You must have a view at the Bank of England. You've got all these smart economists and you've got all these forecasts.
Well, you
must have a forecast for what you think is going to happen to employment.
You can see the path that we've put in the forecast for unemployment. I mean, that's one way of looking at it.
How many is that in actual jobs?
Well, we've actually got a reasonably flat path this year for unemployment, so it's still around 4.5%.
I think one thing is quite important in this context is we don't, by contrast with the OBR, we do not do a forecast on a sort of pre-measure, post-measure basis. No. We do like a February.
Take it as given.
And so it's much, we are not doing a sort of separate forecast of this. It has to be seen in the whole. And that's why separating out, if you like, the marginal effect of this on employment is not really part
So we have got the
framework.
OBR in front of us on
The other thing, by the way, we obviously look quite carefully at because people have to notify redundancies. So and they are aggregated, and we haven't yet seen a pickup in notified redundancies.
So, but we've seen jobs being cut at the fastest rate since 2008, haven't we, Dr. Pill?
Well, in some measures, yes. So, I mean, we have some of these survey measures which I think have the character that the Governor was talking about. I mean, as he also says, that hasn't been shown up in the redundancy notifications, and the issues around employment growth and so forth are all issues that are at the heart of the debate about the quality of the labour force survey, the official data. So, I mean, I don't want to repeat all that argument again, but I think there is a degree of uncertainty here. I think what we can say with some certainty, which I think is kind of an interesting combination, is there have been a set of surveys undertaken, including by the bank, but also by CPI, and who have explored this issue about what margins of adjustment will be adopted in the face of this change in the tax situation. And I think those surveys, as one would expect, suggest all the margins that were described by the Governor are being employed.
I understand that. And Dr. Pill, if you increase the price of employing a person by £900 and they're not expecting it, do you have more people employed or fewer people employed in an economic model?
Right, well, in our economic model, we have fewer people employed. I think the point which is quite telling from these surveys is the level of activity in the economy is sort of going sideways. That's sort of consistent with elements that we've discussed. Employment and employment intentions does look weak, but actually price intentions look quite strong. And so that would suggest, I think, consistent with some of the survey evidence asking specifically about this, but placing it in the broader context that Megan has tried to do about thinking about supply and seeing this over a longer horizon. The combination of weakness in activity and employment, but with strength in some of the nominal dynamics, that is probably associated more with concerns about supply, which would tend to drive up prices while activity is weakening, rather than concerns about demand, which would tend to move demand and supply, prices and activity in the same direction.
Okay.
Thank you for Dame Harriet. John Grady.
Just a quick one for me. Was Greene, charts 2 and 3 in your very interesting paper illustrate the essential truth that we're a very open trading nation, and the US and the EU are our two biggest trade partners. And by the way, the data shows the same for Scotland. The question I'd have for you is,
You'd say England was the largest trading partner for Scotland.
Well, it is, of course, but we're part of one United Kingdom, and it is ill-advised for either of us to stray into that territory this afternoon. No good will come of that. But are there any other international shocks or factors? We've got elections in Canada, which your predecessor might have an interest in. France has gone off the radar, but of course France is politically not a paragon of stability at the minute. Significant increases in defence spending, the Middle East. Anything else on the radar that you see, Ms. Greene, as having potentially a material impact on inflation and the work of the MPC?
Yeah, so as you saw in my speech, the UK is most exposed to the EU from a trade perspective. I would say what was announced last night in Germany actually is quite transformative potentially for spending. It will go to the Bundestag next week, of course, but it's the first time I've been really surprised in my professional life by Germany and their spending. So I think this could be quite a sea change in terms of public borrowing and spending in Europe, which should have spillover effects for the UK. The second biggest trading partner is, of course, the US. There's a lot going on there, but it's not just trade that impacts the UK from the US, it's also financial markets, so that's another connection I would highlight.
And Professor Taylor, anything to add?
I mean, I think there are quite enough factors on my list already. But I would say, at this very moment, the uncertainty over trade policy is very important. I wanted to emphasize that it's not just other countries' choices, it's our choice about how or whether we retaliate and what measures we put in place against which countries. We have a choice there, and that will be extremely important. That's outside of our bailiwick, but it's an important thing to get right.
Thank you. We could debate this for another couple of hours, but I think we'll give our witnesses a break and pause it there. Can I thank you very much indeed. In summary, we've heard a lot of interesting things, but primarily, that we are living in an age of uncertainty, and that the bank is making policy in this age of uncertainty. We've also that if the world, we heard very clearly from the governor that if the world economy is out of balance, the way to resolve that imbalance is in a multilateral rather than unilateral context, and that you warned, Governor, about the risks to the world economy if multilateral institutions such as the IMF are weakened or compromised. So I think that's a very important message you've put on the record there. And of course, tariffs imposed by the United States are very much in everybody's minds and are more likely than not to reduce incomes in the UK. So there's something we all, I know, are all very concerned about. So can I thank you very much indeed for coming. The transcript of this session will be available on the website uncorrected in the next couple of days. So thank you to our colleagues at Hansard for that, and thanks to our colleagues at Bowtie for the broadcasting. Thank you very much indeed. Order, order.